How's it going, everyone? It's Sam. Today we're doing a fun one. We're going to be looking at some different ETFs, some different stocks and companies, and we're going to be seeing how much you need to invest or how many shares you need to retire or get $5,000 a month in dividends. We'll also be looking at something else that's really important when evaluating these companies, which is how quickly they grow, and taking a look at what kind of discount you can get if you invest now and if they grow in the future in terms of how much their dividend will grow. So if you don't mind, hit the subscribe button and like button if you like these videos. Let me know by doing that. And there's a link to M1 Finance. That's where I have my dividend investing portfolio. I'll be looking at some of the companies that are in that portfolio in this video. But if you want to join M1 Finance, you can use the link underneath the video. And just to be clear, this is not going to be me talking about the best companies to buy. There are a couple in here that I don't hold, a couple ETFs that I don't hold either. And if you want to know some of the top stocks, I think for 2023 that are dividend payers, I go through that in this video. I'll put that on the end screen. Now, let's get into it. I categorize this by how much you need to invest. And we're going to start down here at one of the companies you need a little bit more to invest. So let's start with Apple. It's around $130 here today. It pays 0.92 in dividends, or 92 cents a year in dividends at this pace, which means you would need about 65,000 shares if you want to get $5,000 a month in dividends. Now, that would mean you would need about $8.5 million right now if you want to retire just off the dividends from Apple. Makes sense because it pays less than 1%. You would need a substantial amount. Now, from there, we can go up a little bit and look at something that pays a significant amount more, which is VOO. So VOO is the S&P 500 index. It is around $357. It pays $5.95. It's not meant to be a big dividend payer, but it does have dividend paying companies. So it pays around 1.7% as of now. You would need about 10,000 shares, which means you would need about $3.6 million. Now, we could always also just take money out of VOO. A lot of people use the 4% rule, and they just sell some of their shares each year, knowing that the value of their shares is going to go up. The dividends are going to go up over time as well. But again, that's not what we're assuming in this scenario. We're just going off dividends. Now, from there, we can go with something like TXRH, not HR, which is Texas Roadhouse. It's $94, pays a $1.84 dividend, so you need about 33,000 shares, which means you need about $3 million. Now, the cool thing about Texas Roadhouse is how quickly their dividend is growing. You can see here that it's actually growing around 15 to 16% each year over the last 10 years, which will be huge in the long term for this, which we'll show here in a few minutes how important that dividend growth is. From there, we're going to go into something that pays substantially more, which is Pepsi. So Pepsi is around $181, $4.60 dividend, which means you need 13,000 shares or about $2.36 million. Still a substantial amount, right? These are not huge dividend payers. People think of Pepsi as a huge dividend payer, but the fact is the yield isn't super high. Now, you can get into something like a dividend ETF, such as SCHD, which is specifically carrying dividend paying stocks. It pays $2.56 a year, costs $78, which means you need just over 23,000 shares, and that would cost about $1.8 million. Now let's get into some of the bigger dividend payers. Vici Properties is a real estate investment trust, REIT, and that means that they pay the majority of their income in dividends, essentially. And they have a lot of properties on the Vegas Strip. They pay $1.56 a year. They cost about $32. So that means that they pay almost 5% of their cost in dividends each year, 5% in yield, which means you need 38,461 shares or about $1.23 million. Now, from there, we can go one up into something that is definitely riskier, and I should change one other thing. Obviously, I said Texas Roadhouse was wrong, but this should be company or ETF. This is a fund here, JEPI, that is a covered call ETF. and it pays $6.25 a year and only costs $55. There are extra risks in this, but it does pay a substantial dividend. Now, I don't hold this, so do your own research on it, but you would only need about 9,600 shares or $528,000. Now, this all might seem like a lot, right? We're talking about millions of dollars for any of these individual companies. Keep in mind, like I said earlier, you could always sell shares of the company. Also, these will grow over time. And I think one thing that's important to remember too is you can invest slowly over time to get up to these values and get up to these numbers. And you don't have to invest all in an individual company. The other thing, like I said, is dividend growth can be huge. If we look at something like Texas Roadhouse, which has gained 15% annually in dividends over the last 10 years, if we go back to 2012, it paid 9 cents. Now it pays 46 cents. Now, this is an insane growth, and this is quarterly. So it pays 5 times more dividends now than it did 10 years ago, which is a substantial growth rate, meaning you really have to buy less shares if you're looking out into the future. So if you look at different dividend growth rates, we'll look at 3, 9, and 15% here. You can discount it over the next 10 years. So how much would you discount, and what would that actually mean for how much you have to invest? Well, if you get a 3% growth rate, and you discount it over 10 years, you can get a discount of 25%, meaning if you want the same punch or you want the same amount of dividends, if you needed $1 million today, you'd only need $744,000 in 10 years. If it grows 9%, which there are a handful of companies that grow 9%, I think Vici's right around 9%, and they pay almost 5% right now. So they grow 9% a year. Discount rate over 10 years would be 57%, which means if you wanted the same bang for your buck in 10 years that you have now in terms of dividends, you would only have to invest $422,000, and that would give you the same dividends as $1 million today. But that would be 10 years in the future. And then if you were going up to something like 15%, which is very similar to what we were just looking at, Texas Roadhouse, that means you could discount about 75%, which means what $1 million worth of their shares would pay right now in terms of dividends would be the same as if you just held on to $247,000 worth of shares, let it go 10 years, that's how much it would pay in 10 years as well. Now, if we look specifically at Texas Roadhouse, if you had about $1 million worth of Texas Roadhouse today, it would pay you about $20,000 a year in terms of dividends. But as that grows, you could have just $247,000 today, and then in 10 years, it would be paying you about $20,000 a year if it grew at that 15% rate. Now, let me know your thoughts on this underneath the video. Again, I think diversification is key, and I personally don't only hold dividend stocks, I hold other growth stocks. And you need to make sure that the companies that you're investing into don't just pay a high dividend, but actually have a good growth story or can grow substantially or consistently over time, that they have good fundamentals in their business. Let me know your thoughts on this underneath the video. Let me know if you want to see more of these. Check out the link to M1 Finance. And if you want to join the Patreon to see exactly what I'm buying and selling in my dividend portfolio, you can check that out underneath the video as well. Thanks, and I'll see you in the next one. Bye.